Hello and welcome. For centuries, investing was seen as an art, a blend of intuition, experience, and personal judgment about companies, managers, and the overall market. But over the last few decades, a new player has entered the arena, one that speaks the language of math, statistics, and code. This is the world of quantitative investing. You've probably heard terms like quant funds, algos, or systematic trading thrown around. It can sound like the exclusive domain of physics PhDs and computer science wizards working on Wall Street. And while that's certainly true at the highest levels, the core ideas of quantitative investing are now filtering down to everyday investors like you and me, changing how we think about building our portfolios. In this video, we're going to pull back the curtain and demystify this high-tech approach. We'll break down what quantitative investing really is, explore the key factors that quants search for, and most importantly, show you how this data-driven revolution is now accessible to you through simple, low-cost investment products. This isn't about replacing human judgment. It's about enhancing it with powerful, empirical evidence. So, let's decode the quants. At its very heart, quantitative investing is the application of mathematical and statistical models to identify investment opportunities. Think of it as finance meets the scientific method. Instead of asking, "Is this a good company with a visionary CEO?" a quant asks a different question: what measurable characteristics have historically been associated with higher stock returns across the entire market, and how can I systematically find stocks that possess those characteristics today? The process is disciplined and methodical. It usually starts with a hypothesis. A researcher might identify a potential factor they believe predicts returns. For example, stocks with low price-to-earnings ratios tend to outperform over time. Next comes backtesting. They use decades of historical market data to test this hypothesis rigorously. Does the pattern hold up across different time periods, market cycles, and even in different countries? If the hypothesis is validated, they build a rules-based model to screen for and rank stocks based on this factor, often in combination with many others. Finally, algorithms handle the execution, the actual buying and selling. This ensures the portfolio stays true to the model while managing risk and minimizing transaction costs. The whole point of this approach is to remove human emotion and cognitive biases from the investment process. The model is the strategy, the algorithm is the disciplined executor. So, what are these measurable characteristics, these factors that quants are looking for? Think of them as the nutritional labels for stocks. Decades of academic research, most notably from economists like Eugene Fama and Kenneth French, have identified several persistent factors that explain a significant portion of stock returns. Let's look at the most well-established ones. First, there's value. This is the tendency for stocks that are cheap relative to their fundamental business metrics like their book value, earnings, or cash flow to outperform expensive stocks over the long run. This is the classic Warren Buffett-style idea, but applied systematically across thousands of stocks, not just a select few. Next up is size. This is the historical tendency for stocks of smaller companies to outperform stocks of larger companies. This outperformance often comes with higher volatility, but the long-term data is compelling. Then we have momentum. This is the tendency for stocks that have performed well in the recent past, say, the last 6 to 12 months, to continue performing well in the near future. And on the flip side, for losers to continue losing. This often contradicts the classic buy low, sell high advice, but it has incredibly strong empirical backing across global markets. Another crucial factor is quality. This is the tendency for companies with strong, stable fundamentals to outperform weaker companies. We're talking about businesses with high profitability, low levels of debt, and consistent earnings growth. These are the blue-chip, steady-eddy companies of the market. Finally, there's low volatility. This is a somewhat counterintuitive finding that stocks with lower historical price swings can actually deliver higher risk-adjusted returns than the overall market. This factor is prized for building portfolios that offer a smoother ride, especially during turbulent times. A quantitative fund might screen thousands of stocks, score them on these different factors, and then purchase the ones with the highest combined factor score. Now, you might be thinking, this is all fascinating, but I don't have a supercomputer or a PhD in statistics. How does this help me? This is where the real revolution for individual investors begins. You don't need to build these complex models yourself. The game changer is the rise of factor ETFs, often marketed as smart beta ETFs. These aren't your traditional index funds, which simply track the market by company size, like the S&P 500. Instead, these ETFs track a custom, rules-based index designed specifically to capture one or more of these proven factors. So why does this matter for your portfolio? First, it gives you access to institutional-grade strategies. For a very small fee, you can now invest in a portfolio constructed using the exact same academic research that guides trillion-dollar pension funds and endowments. Second, it allows for targeted exposure. You can actively tilt your portfolio towards specific factors you believe in. For example, if you're worried about high market valuations, you might tilt your portfolio toward quality and low volatility ETFs. If you believe we're entering a period where undervalued companies are set to rebound, you can add a specific value factor ETF. The goal of these funds is to deliver better risk-adjusted returns than a simple market cap-weighted index over the long term. And this is a critical point, this is never guaranteed. Factors can go through very long periods of underperformance, which leads us to the crucial reality check. Here's what the quants don't always advertise. First, factor cycles are real. Just like different sectors of the economy, factors go in and out of favor. The value factor, for example, underperformed significantly during the tech-driven bull market of the 2010s. This tested the patience of even the most disciplined investors. You have to be prepared to stick with the factor, even when it's not working, to reap the long-term rewards. Second, beware of the factor zoo. As more researchers dig through data, hundreds of supposed new factors have been discovered. The reality is that many of these are likely just statistical noise or data mining artifacts that won't hold up in the future. It's best to stick to the few that are robust, well-researched, and make intuitive economic sense like the ones we just discussed. Finally, implementation is key. High fees, poor index construction, or excessive trading by a fund manager can completely erode all the theoretical benefits of a factor strategy. When you're choosing a factor ETF, always go with low-cost, transparent funds from major, reputable providers. So, let's quickly recap the key takeaways. Quantitative investing is a systematic, rules-based approach that uses data and models to find stocks with desirable characteristics or factors. The most established factors are value, size, momentum, quality, and low volatility. Your access point to these strategies is through low-cost factor ETFs, also known as smart beta. Quantitative investing represents a fundamental shift in finance, from storytelling to statistics, from persuasion to proof. It doesn't make traditional stock picking obsolete. Rather, it provides a complementary, disciplined framework for making investment decisions. For you, the individual investor, this means you have more tools and more control than ever before. You can choose to simply own the entire market with a broad index fund, or you can choose to intelligently tilt your portfolio toward the specific, research-backed factors you believe will win in the next chapter of the market story. The game is still about trying to build wealth over the long term. But now, the players have powerful new maps drawn by data. Thank you so much for watching. If you found this video helpful, please give it a like and consider subscribing for more content that breaks down the world of finance. See you in the next one.